Here are today's top 6 macro stories. The United States Treasury just stepped into its own bond market to hold down the government's borrowing costs. One day later, the market called the bluff. 1. On Tuesday, the 30-year Treasury yield touched 5.34%, the highest cost of long-term money for the American government since 2007. On Wednesday, the national debt crossed $40 trillion for the first time. And on the same day, Treasury Secretary Scott Bessent made his move. The Treasury will at least double its buybacks of its own long-term bonds from $2 billion to at least $4 billion per operation, inside a repurchase program totaling $83 billion through early November. Officially, this is liquidity support. Unofficially, read the calendar. The long bond breaks to a 19-year high, and within a day, the government is buying its own debt to push the price back up. It worked for exactly one session. The 30-year fell to around 5.18, the 10-year dropped to about 4.66. Then Thursday, yields rebounded and wiped out most of the relief. Here is the power story underneath. Setting the price of money is supposed to be the Federal Reserve's job, and the new Fed chair, Kevin Warsh, has said he is not constrained by market prices and wants markets to clear on their own. So the elected side of the money system just intervened where the independent side refused to, with $5.5 trillion of 20 to 30-year bonds outstanding. Whoever controls that yield controls mortgages, corporate debt, and every valuation in the market. The debt is $40 trillion. The question is no longer the number, it is who still finances it, at what price, and who decides. 2. 6 months into the Iran war, President Trump declared what he called economic D-Day. Secondary sanctions on any country whose banks, businesses, or ship registries touch Iran. Oil smuggling, swap lines, cash transfers, his words, all of it needs to stop now. Oil rose again, with West Texas crude near $86 and some Brent prints reported above 94. The Strait of Hormuz is running at roughly half its pre-war volume under naval escort. Secondary sanctions turn the dollar system itself into the weapon. Every country now chooses Iranian trade or American banking. 3. Walmart just posted its slowest growth in United States comparable sales in 6 years. Guidance stayed cautious, around 4% sales growth for the year, and the chief executive named the cost driver plainly. Every tariff creates cost pressure, and China's are the biggest. Walmart is the closest thing America has to a real-time consumer gauge. When the discounter of last resort slows down, the tariff pass-through debate stops being a theory and starts being a receipt. 4. The 50% tariffs on Canadian goods did not fire. After a phone call between President Trump and Prime Minister Carney, the White House paused them, citing a deal in progress. Ottawa's answer: important work still remains, and nothing is signed. A pause pending a deal is leverage on a timer that Washington alone controls. Canadian exporters price that uncertainty every single day it continues. 5. Gold broke out of its summer range to a 2-month high near $4,550, not on an inflation print. On this week, a bond market fighting its own government, and a sanctions ultimatum in the Gulf. Gold is the one asset on this board that does not depend on anyone keeping a promise. A high on these headlines is the market pricing doubt in institutions, not prices. 6. Next week, Kevin Warsh gives his first Jackson Hole speech as Fed chair, August 27th through the 29th. He has promised a big picture address, and he has repeated that he is not constrained by market prices. That was before the Treasury moved into his lane. One podium, one speech, and every asset priced off the risk-free rate repositions. It is now a referendum on who runs the long end. The debt crossed $40 trillion. The Treasury started buying its own bonds, and the market pushed back within a day. That is macro today. Here is today's question for you. The elected Treasury is now buying bonds to hold down the government's own borrowing costs, while the unelected Fed chair says markets should find their own price. Which one do you actually want setting the price of money? And at $40 trillion of debt, would you trust either? Tell me in the comments. I read them. Blue pill. This is plumbing, not politics. Buybacks add liquidity to an illiquid long end. The Fed keeps its independence, and the system is bending exactly the way it was built to bend under stress. Red pill, fiscal dominance, is already here. At this size of debt, the government cannot afford honest prices, and every institution, elected or not, bends toward financing the state. The market erased the intervention in one day. It already knows. The timeline keeps moving. We will see you in the next one.